Hello everyone, welcome to the Capital Intelligence Channel. I am absolutely thrilled to bring you today's explainer where we're going to unpack the brutal statistical realities and the essential survival mechanics of retail trading. Now look, if you're serious about finance and investing and you're ready to move past the social media hype to understand the actual data that separates the successful professionals from the rest of the pack, well, you're exactly where you need to be. We're about to dig into some incredibly high-value insights pulled directly from exchange data, academic research, and broker disclosures. The goal here? To build a rock-solid framework for market survival.
Let's start things off with a staggering fact that honestly serves as a massive reality check for any serious investor. A full 80% of retail traders quit within just 2 years. I really want you to think about that for a second. 8 out of 10 people who decide to actively trade the markets just completely throw in the towel before they even reach their second anniversary.
Okay, let's dive into this. Why do so many fail? Why do between 70 and 90% of retail traders end up losing money? You know, it's incredibly common to hear folks blame a rigged market or claim the big institutions are somehow out to get them. But the actual data tells a completely different story. The failure isn't because the market is rigged against you. It's actually because of some deep-seated structural and psychological realities that most beginners are just completely unaware of.
All right, moving into Section 1, the retail attrition cycle, or what we can call the 2-year terminal threshold.
To really wrap our heads around this, let's examine the documented timeline of a typical retail trader's lifespan. When we look at the hard data, the sheer speed of the drop-off is practically startling. Just look at that first month. 40% of all new traders quit in just 30 days. The initial shock of market volatility, combined with the sudden realization of unprofitability, is literally enough to wipe out nearly half the playing field right out of the gate. By the time we hit the 1-year mark, 75% are gone. And at the 24-month mark, that's where we hit that 80% threshold. This 2-year mark is absolutely critical because it represents the exact point where a trader's initial capital and their emotional resilience are just completely exhausted. And here is the core mathematical reason why all that capital disappears so quickly. It's called the inverse risk-to-reward ratio. Statistical analysis confirms that retail traders sell their winning positions at a 50% higher rate than their losing ones. Think about what that actually means. You could theoretically have a highly successful 70% win rate, meaning you are picking the right direction the vast majority of the time and still go entirely bankrupt. Why? Because the few unchecked losing trades you hold onto, praying they'll miraculously turn around, end up being 500% larger than your average wins. It's just a brutal mathematical trap.
Which brings us to Section 2, Psychology and Cognitive Biases, the hidden enemies.
Because, let's be real, mathematical traps don't set themselves, right? They're triggered by the hidden enemies inside our own heads. So let's look at the psychology that actively destroys trading accounts. There are 3 major psychological forces working against you here. First is loss aversion. That's that desperate, awful feeling that makes you hold on to a losing stock, hoping it turns around just so you don't have to admit defeat. Then we have overconfidence. This happens when you get a couple of small wins under your belt, suddenly feel invincible, and decide to take massive, aggressive risks. And finally, herding behavior. This is simply following the crowd without having any personal edge or strategy. You're buying just because everybody else is buying.
And speaking of herding, wow, the modern environment has set a massive external trap for inexperienced traders, the rise of finfluencers. Social media creates intense FOMO, the fear of missing out. Now, according to studies, even though 83% of retail investors believe finfluencers are primarily motivated by self-interest, they still follow their advice anyway. It's wild to think about. This dynamic causes inexperienced traders to chase wildly inflated prices and enter trades far, far too late. Basically, they're buying in exactly when the smart money is cashing out. And this brilliantly illustrates how these psychological biases don't just happen in isolation. They create a fatal cascade effect. Step 1, you trade without a stop loss because of overconfidence. Step 2, the loss grows unexpectedly large, which immediately triggers that loss aversion we talked about. Step 3, instead of just walking away and taking the hit, you engage in revenge trading to try and win back the lost money. And Step 4, you oversize the new position in a complete panic. Suddenly, what was supposed to be a planned, manageable $250 loss has snowballed into a $1,500 account blowout.
Let's shift to Section 3, the demo trading illusion. Same market, completely different reality.
Now you might be thinking, hey, I'll just practice on a demo account first to master my psychology. But consider the stark contrast here. On the demo side, the environment is pristine. You've got zero spread, instant simulated execution, and absolutely zero emotional stake. But on the live market side, you are dealing with dynamic spreads, execution slippage, and a massive emotional stake. In a demo account, you might hold a losing trade until it bounces back simply because you don't care. In the live market, that same drawdown triggers what researchers call an amygdala hijack. Basically, your brain reacts like a caveman fleeing a saber-toothed tiger, even though you're literally just staring at a red candle on a computer screen. That's why a profitable demo strategy will frequently and completely collapse under live emotional pressure.
Moving right along to Section 4, High-Frequency Trading Realities, the Structural Disadvantage.
As if the psychological battle wasn't hard enough, we also have to acknowledge the unseen structural realities of the market. You are not just trading against other humans out there. You are trading against automated institutional algorithms. One of the primary strategies they use is called latency arbitrage. This is the practice of taking advantage of momentary cross-market inconsistencies in prices due to informational delays. And when I say delay, I'm not talking about seconds. Retail traders are competing in automated races that last just 5 to 10 millionths of a second.
To anchor this with some hard data, a comprehensive Fordham University study on the evolution of high-frequency trading noted something absolutely crucial. While HFT definitely does provide overall liquidity to the markets, strategies like latency arbitrage essentially act as a hidden liquidity tax on the retail trader. In fact, research estimates that this structural speed advantage costs global equities around $5 billion annually. It's this constant, unseen friction that makes your climb to profitability just a little bit steeper.
Which brings us to our final part, Section 5, Risk Management over Entries, the Professional Survival Framework.
So, with the math, the psychology, and the structural speed of the market all working against you, how in the world do the professionals actually survive? Well, I absolutely love this quote from trading psychologist Alexander Elder. Entries don't keep you alive, risk management does. See, amateurs obsess over predicting the perfect entry. They want that flawless setup. But professionals, they know that precision means absolutely nothing if it compromises survival. They operate entirely differently, prioritizing strict risk limits above everything else.
Let's look at how this builds a concrete system. The professional survival framework is brutally simple. First, you define a maximum risk of just 1 to 2% of your total capital per trade. Second, you set a strict, non-negotiable stop loss in the market. And third, you accept that small loss is a completely normal business expense, kind of like paying the electricity bill for a storefront. Just look at the math here. If you strictly follow a 1% risk rule, it would literally take 50 consecutive losses just to lose half of your account. And that right there is how you stay in the game long term.
It all ultimately comes down to survival logic. Before a professional even thinks about profit, they ask one simple question. If this trade fails, what happens? Because they plan for the absolute worst-case scenario and know exactly what their maximum dollar loss will be. Before they click buy, they achieve complete psychological freedom. They don't need courage to trade, because preparation completely eliminates the need for courage. Their amygdala isn't getting hijacked, because there are zero surprises. Which brings us to the ultimate question you have to ask yourself after reviewing all this data. Will you be the trader who obsessively tries to predict the market, chasing perfect entries and falling prey to emotional cascades? Or will you be the professional who manages risk to survive it, calmly treating small losses as just another business expense? The choice is entirely yours. Thank you so much for joining me on the Capital Intelligence channel today, and definitely use these insights to thrive out there in the markets.